All right, I want you to try a little visualization exercise with me. Just for a second. Close your eyes. Picture a construction site. Mud, noise, the whole thing.
Okay.
And right in the middle of it all, sitting in the dirt, is a steel pipe. Just a big, gray, hollow cylinder. It's probably one of the most boring objects on the planet. Are you asleep yet?
I'm actually on the edge of my seat because knowing you, that boring pipe is about to turn into a very, very interesting pile of money.
You know me too well. Open your eyes. What if I told you that this boring pipe business just posted its highest quarterly margins in its entire history?
Okay, now you have my attention.
And what if I told you that as of this morning, Tuesday, February 10th, 2026, we have analysts predicting that this company's stock could jump anywhere from, say, 39% to over 80%.
An 80% upside, wow. That's the kind of math you usually hear about in, like, AI or biotech, not heavy industry.
Exactly. Welcome to the Deep Drive. Today we're looking at Man Industries, India, LGD, ticker symbol MM.
And we've got fresh data.
It's literally hot off the press today. Two big analyst reports, one from Choice Institutional Equities and another from SBI Securities, who are actually calling this stock a rising star.
And what's so fascinating here is that this isn't really a story about steel pipes. I mean, it is on the surface. But financially, it's a case study in transformation.
How so?
Well, we're looking at a company and changing its product mix to, explode its profitability. It's expanding into Saudi Arabia, right into the heart of the oil world. And this is the real wild card. It's sitting on this hidden real estate asset that has nothing to do with pipes at all.
I do love a hidden treasure chest. Okay, let's start with the immediate news, the hard numbers. Man Industries just dropped their Q3 FY26 results today.
And the headlines are interesting.
Yeah, you really have to do a double take. Okay, so look at the top line. Revenue is up 13.4% year over year. They brought in 8.3 billion INR.
Which is solid. It's good. Double-digit growth. Respectable.
Right. It's respectable. It's not earth-shattering. But then you look at the profit lines, and the graph just goes vertical.
Yeah, it does.
EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It jumped 62.1% year over year to 1.28 billion INR. Net profit is up 61.3%.
So revenue up a little, profit up a massive amount.
How does that math even work?
That is the magic of what we call operational leverage combined with product mix. This is why the analysts are so excited. I mean, usually in manufacturing, to grow profit by 60%, you need to sell 60% more stuff.
Right. Build more factories, hire more people.
Exactly. Man Industries didn't do that. They just sold better stuff. They're not just chasing volume for the sake of it anymore.
You could see that in the reports.
Precisely. The Choice Equity Report highlights this favorable sales mix. They're prioritizing the higher margin orders. And the proof is right there in the margin number itself. Their EBITDA margin hit 15.4% this quarter.
Let's pause on that. 15.4%. Is that good for a pipe maker?
It's historic. It is their highest quarterly margin ever. To give you some context, that's an expansion of about 460 basis points year over year. In the world of steel, where you're often fighting for, 8 or 9%, jumping to the mid-teens is a total game changer.
Okay, so that explains the blowout quarter. But looking at these reports, both SBI and Choice seem to think this is just the appetizer.
It is. They're looking ahead to FY27, which is just around the corner, as the main course. And that's because the company is building two massive future engines. They've been spending on CapEx, and those projects are about to come online.
Let's talk about engine number one.
Yeah.
Saudi Arabia. This seems to be what has the analysts really buzzing.
This is the big strategic shift. They're building a 300,000 metric tons per annum plant for HSO pipes in Saudi.
And HSO is helical submerged arc welded. The really big pipes for oil and gas.
Correct. The massive arteries of the energy world. And why Saudi? Well, SBI Securities points to the proximity to Aramco and the booming demand in the entire GCC region.
So it's about being where your customer is.
Exactly. Think about it. If you're Saudi Aramco, the biggest oil company on the planet, do you want to import giant, heavy steel tubes from India? You're basically paying to ship air.
The logistics costs must be a nightmare.
Insanely high. But there's another layer here. Saudi Arabia has very strict local content rules. They want things made in country. By building a plant in Saudi, Man Industries becomes a local supplier.
They get that ticket to the VIP table.
Exactly. And the Choice Report, they're targeting revenue of 15 to 20 billion INR from this plant alone, and that's at only 50 to 60% utilization.
Wait, hold on. Their total revenue for this entire quarter was 8.3 billion.
I know.
This one plant at half capacity could generate 15 to 20 billion in a year.
It's a massive addition. It could essentially double their current run rate, and the margins are expected to be healthy, around 12 to 14%. But the crucial part is the timeline. This isn't some 3 years from now dream.
When does it start?
They're targeting commercial production for Q1 of FY27. That's just a few months away.
That is incredibly close.
Yeah.
So we have the volume play in Saudi. That brings us to engine number 2. This one's back in India, in Jammu.
Right. And if the Saudi plant is about scale, the Jammu plant is all about value.
This is the stainless steel one, right?
Yes. It's a smaller capacity, only 22,000 tons, but it's for stainless steel pipes.
And I'm guessing stainless steel isn't the same as regular steel when you're looking at the bank account.
Not even close. Stainless steel is a specialized, value-added product. It's used where regular steel would just rust away. And because of that, it commands a huge premium.
How much of a premium are we talking?
Well, analysts are projecting EBITDA margins of 18 to 22% for this facility.
Wow. So nearly double the margin on their traditional business.
Precisely. This goes right back to that product mix story. They're deliberately moving up the value chain, and this plant is also coming soon, Q2 of FY27. So within about 6 to 9 months, both of these engines turn on.
That's a lot of construction. Is there a risk that, it just doesn't get finished?
That's always a fear. But according to the reports, 75% of the spending for these factories is already done. The buildings are up, the machinery's being installed, the risk of will they build it is pretty much behind them.
Okay, so we have record margins now, 2 new factories about to open. But what about the actual customers? Do they have people lined up to buy the pipes?
That brings us to the order book. And this is where analysts use that favorite word of theirs, visibility.
I love that word. It's analyst speak for, we know where the money's coming from, so we can all sleep at night.
Pretty much. As of December, their order book stands at roughly 40 billion INR.
And that's executable soon.
In the next 6 to 12 months. So it provides a very solid floor for their performance for the next year.
That's basically a year of revenue locked in.
Essentially. And what's interesting is the composition. About 80 to 83% of it is exports.
That's high. Why is that important?
It shows they're not just reliant on the Indian domestic cycle. They're winning globally. Southeast Asia, the Middle East.
Right.
It's a hedge.
Although the Choice report did mention the Jal Jeevan mission in India.
True, the domestic market is definitely active, and they're bidding there. But the big money, the really lucrative wins, are coming from abroad right now.
And speaking of bidding,
Yeah.
40 billion is what they've won. What are they trying to win?
The bid pipeline. Active bids they're fighting for right now. That stands at 115 billion INR.
That's a massive number, almost 3 times their current order book.
It is. And management says their historical win ratio is around 20 to 30%. So if you do the napkin math, that's potentially another 23 billion flowing into the order book soon.
It really feels like the machine is humming. But, and there's always a but, there's something else in these reports that doesn't fit at all.
Yes.
The real estate.
The plot twist. Why on earth does a pipe company own a massive piece of land in Navi Mumbai?
It's a classic case of legacy assets. A lot of older industrial companies in India bought land decades ago. Back then, Navi Mumbai was out in the sticks. But the city grew, and now that land is incredibly valuable. This parcel is called Merino Shelters. Merino Shelters. Sounds like a beach resort.
Well, it's a residential development now. And here's the smart part. They're not building it themselves. They've partnered with a developer, Paradise Group.
And what's the payout on that? Choice Equity seems pretty excited about it.
Choice estimates this project will generate between 6 and 8 billion INR in revenue for Man Industries over the next 6 or 7 years.
6 to 8 billion. That is not pocket change.
Not at all. To put that in perspective, Choice says that's equivalent to about 25% of the company's entire market cap right now.
Wait. Let me get this straight. You buy the stock for the pipe business, the Saudi expansion, all of that. And you basically get a real estate check worth a quarter of the company for free.
That's the hidden asset thesis. The market often ignores these non-core assets because they don't fit into the spreadsheet. But cash is cash.
And what are they doing with that cash?
Paying down debt. Management has been clear this is cost-free inflow. That cash comes in, goes straight to cleaning up the balance sheet.
Which reduces interest costs.
Which boosts profits even further. Imagine a scenario in 3 years. The new plants are printing money, and the debt is vanishing. That's a very powerful financial engine.
It sounds almost too good to be true. Which brings us to valuation. We have 2 targets, Choice Equity and SBI Securities. Both say BUY, but their targets are really different.
Very different. It's a classic tale of two methodologies.
Let's start with Choice. They're the more conservative one.
Yeah. Choice has a target price of 535 INR. From the current price, that's an upside of about 39%.
Which is still a fantastic return. How do they get there?
They're using an EV to capital employed framework. It's great for heavy industries. It basically asks, how much value is the market giving you for the actual capital, the machinery, the factories invested in the business? They're being prudent.
They're saying, show me the money first.
Exactly. They want to see the new plant actually generating returns before they fully price it in.
Okay, that's sensible. Now, what about SBI Securities? They're calling it a rising star.
SBI is much more bullish. Their target price is 694 INR. That's an upside of over 80%.
80%. Why the huge gap?
SBI is looking further out to FY28 and using a price-to-earnings multiple. They're valuing the business at 12 times its expected FY28 earnings.
So they're fully pricing in the success of the new plants.
They are. They're saying, we believe these earnings are coming and we are willing to pay for them today. They're forecasting profit to grow at a compound rate of nearly 42% a year for the next 3 years.
And if you believe that kind of growth, a 12x multiple is actually kind of cheap.
It is. That's the argument. They're betting Man Industries is transitioning from a slow-growth industrial to a high-growth manufacturing play.
And despite the different targets, they both agree on one thing. Q4, the quarter we're in right now, is going to be a monster.
Yes. Management has guided that Q4 will be the strongest ever. So we might get a confirmation of this whole growth thesis very soon.
Okay, we have to be the adults in the room now. We've talked about 80% upside, free money, booming factories. What could go wrong?
Execution. That's the biggest risk. Building a factory in Saudi Arabia is complex. If that plant is delayed by 6 months, or if utilization doesn't ramp up quickly, those future earnings numbers come crashing down.
And the stainless steel plant.
Same thing. It's a new technology for them. Quality control is everything. One bad batch and you can't sell it. That hits margins immediately.
And that huge bid pipeline, $115 billion.
A pipeline is just a list of opportunities. It's not money in the bank. If the global economy slows, if oil prices crash, that pipeline could dry up very quickly.
And I suppose the real estate isn't risk-free either.
Not at all. It's notoriously bureaucratic. Delays could push that cash further and further into the future.
But even with those risks, it seems like the analysts see a big margin of safety here.
That's the key. The market seems to be pricing this like a boring, old-school pipe business. It's pricing in the past, not the future they're building.
So to wrap this up, Man Industries. This is not just pipes anymore.
No, it's a transformation story. They're moving up the value chain, becoming more efficient, and de-risking the balance sheet. It's rare to see a company where the boring core business is hitting record profits just as the exciting new projects are about to come online.
It really is a sweet spot. The operational leverage is kicking in right now, and the capacity expansion kicks in next year.
Exactly.
So here's the thought I want to leave you with. We have two very smart analyst teams looking at the same company. One sees a 39% gain, the other sees an 80% gain. That's a huge spread.
A huge spread.
It tells me the market is having a really hard time valuing what's about to happen in Saudi and Jammu.
Or they're completely ignoring the real estate.
Exactly. So if the conservative view is a big win and the optimistic view is a home run, you have to ask yourself, is the market asleep at the wheel on this one? Or is there a hidden execution hurdle in the desert that we just can't see yet?
That's the multi-billion rupee question. The numbers say buy, but execution will determine how big that buy really is.
And that's why we do the deep dive. All the source documents, the charts, the real estate breakdown, they're all in the show notes. Check them out for yourself.
It's definitely one to watch.
Thanks for listening, everyone. We'll catch you on the next one.